If you're a real estate investor and you're about to sell one of your investment properties, you're going to have, unfortunately, an extra partner in that transaction, the IRS. They want their fair share of the taxes, but there could be a way to legally cut them out. It's called the 1031 exchange. Let's dive in. When it comes to real wealth creation, real estate is an amazing tool in your tool chest. Now, there are some roadblocks in that journey, though. The number one roadblock tends to be taxation. If you were to buy a property today and it goes up in value and you sell it down the road, you're going to get exposed to something called capital gains tax. Now, there is a workaround for the lucky few who qualify. It's referred to as Section 1031 of the Internal Revenue Code, but there are a number of rules you need to understand before trying to implement this strategy. Let's jump into them one at a time. The first thing we need to contend with is the fact that this particular strategy is only applicable to buy and hold real estate investors. So if you're short-term in nature, like a fix and flipper or a real estate wholesaler, this strategy isn't for you. The other thing we need to understand is what's actually happening inside of a 1031 exchange. You see, the whole benefit of the strategy is that it gives you the ability to sell one asset, carry forward the basis in that asset into a new asset that's being purchased, and the fact that we're carrying forward the basis, it gives us the ability to avoid capital gains treatment. Now, it doesn't avoid it forever, because in the future, if we ever sold the second asset that's being purchased, there would potentially be a capital gains at that time, unless we did another 1031 exchange. Now, in order to effect a 1031 exchange, we also have to understand this concept called like-kind exchange. The particular phrase itself doesn't necessarily mean what you think it may mean. It simply means that it must be like-kind in nature, specifically in the nature of real estate. So as an example, I could own property that has a house on it, sell that property, and buy raw land. That still qualifies, even though it's not exactly the same. I could also have a property that has a home on it, sell that property, and buy another property that has 3 homes on it. Again, not exactly the same, but like-kind in nature. This is opposed to, for instance, having a property that has a home on it, selling it, and buying an RV or a houseboat. Those are not like-kind in nature. But once we have an understanding that the transaction that's going to happen is like-kind in nature, that means it qualifies. But in order to qualify and use this strategy as a whole, you also need to have some formalities that are involved in this particular transaction. The number one formality is you must use something called a qualified intermediary for the transaction itself. That's an actual entity that is in the business of handling transactions like this. They will act sort of like an escrow agent for the entirety of the transaction, the sale of the one asset and the purchase of the other. As long as the proceeds in this particular transaction stay with that qualified intermediary from sale of the one asset to the purchase of the other, we're perfectly fine. However, if you were to receive the proceeds of the sale, well, then you would be ineligible to use the 1031 exchange. So having that qualified intermediary is a required step here. You can't touch the proceeds in this particular transaction. Now, there's a second formality. It has to do with time. In order to take advantage of this particular strategy, when you have sold your property, you must notify that qualified intermediary within 45 days of the property you intend to purchase with the proceeds of the first sale. Now, if you fail to do that, again, the 1031 exchange will be void. Now, within that environment of notification, I know that can be a bit of pressure. In fact, 45 days doesn't seem like it's anything that a real estate investor would have ever come up with. So this is definitely a creature of Congress. But when you look at this concept, you're not limited to just identifying one property. In fact, you can share with that qualified intermediary up to 3 properties. That could give you some choice. Now, there is a rule that allows you to actually share more than 3 properties, but you are limited because in that environment, if you're sharing more than 3 properties, the total value of all the properties you're sharing with that qualified intermediary, it can't be greater than 2 times the value of the property you sold. So again, a little bit of nuance here. Now, here's the thing. If you fail to identify a property within that 45 days, the whole transaction is void when it comes to the 1031 exchange, at least. Now, there is a second time frame. When you sell your property, you have up to 180 days to actually close on the new property to be acquired. And if you fail to do that, the 1031 exchange is voided. Now, if you're in a tight spot, you've sold your property and you're having a difficult time finding a property to exchange in this particular transaction, there is an alternative. You can use something called a Delaware Delaware Statutory Trust, which will pool together investment proceeds from multiple real estate investors and use those proceeds to go out and purchase more real estate. But the challenge with that is oftentimes the actual returns in those types of transactions are much less than you'd be able to receive in your own type of transaction, your own identified property, and your own ownership. That's more like an investment pool with other investors and having someone else manage that particular transaction on your behalf. So it's not really right for everyone, but it is a safety net of sorts. The benefit of the 1031 exchange is all of the tax deferral, but there could be a scenario that still results in taxation for you in this particular transaction. Specifically, it has to do with the sale price of the property and the purchase price of the new property being acquired. If the new property is not at least equal to or greater in value, there's a high probability that you'll be hit with tax. When you sell a property, and let's say that property was $500,000 in value, and you buy a property that was $400,000 in value, you will actually receive $100,000 of the sale proceeds back at the end of the 1031 transaction. And that money that you receive back, that's referred to as boot. I know it's a funny word. It just simply means taxable income to you. And when it comes down to it, that taxable income is going to be considered capital gains. Here's the thing. It does not have to be actual cash proceeds back to you to trigger boot. In fact, it could just simply mean difference in debt. Same scenario. You have a house that's $500,000, but let's assume you had $400,000 of mortgage. If you were to purchase a property that's still $500,000 in value, the new property is equal in value, but let's say the mortgage on the second property was $300,000. Well, the difference of $100,000 in debt, even though you didn't receive it back, that's going to be considered taxable to you. Now, when you look at the overall transaction, there are also some scenarios that we need to contend with. The number one scenario that I see a lot of real estate investors having challenges with, so far with regard to what we've laid out here in this 1031 exchange scenario, it's referred to as the delayed transaction model. That's when you are selling property A, identifying property B within 45 days, and ultimately closing on property B within 180 days. But you don't necessarily need to have a delay. If you could arrange it, you can engage in what's called a swap. You still need that qualified intermediary to act as the escrow agent for the transaction. But again, if you can arrange it, you could sell property A and purchase property B all on the same day. There's also something referred to as the reverse 1031 exchange. In this scenario, you are purchasing property B, and that at some point in time within 180 days, you're selling property A. And this gives you the ability to take advantage of the 1031 exchange benefits. All in all, the whole concept of the 1031 exchange, it gives us the ability to defer taxation, because at the end of the day, if you can push that can down the road long enough, maybe you can get out of taxes entirely. Section 1031 of the Internal Revenue Code is quite complex, as noted by all the nuances that I shared in this particular post. But you can absolutely 100% dive headfirst into navigating those waters on your own, but I've done the homework for you. I put together an entire guide. It lays out the concepts that I shared here, plus some of the nuances that I didn't have time to get into in this particular post, and I don't want you to miss out. In fact, I put this guide together and I'm going to give it to you for free. In order to get it, all you need to do is take a look at the link in the description below.